No matter the size of the business, credit sales, credit policies, and whether to accept credit cards are important decisions. In this video, we'll talk about how credit sales and credit card transactions impact businesses, both operationally and from an accounting perspective. Credit sales happen when a business sells a product or service to the customer today, but doesn't expect payment until later. In most businesses, net 30-day payment terms are common, but some businesses also offer discounts for earlier payment, such as 1% discount if the customer pays within 10 days of the invoice. So in terms of a credit sale, the business essentially gives an interest-free loan to the customer, and there's of course the risk that the customer doesn't pay. That is something the business has to consider. Can the business afford not collecting on a sale? Does the business's suppliers require faster payments? It's definitely a decision about cash flow. Does the business have enough cash to pay suppliers now, but not collect from the customer until later? I've worked for small, medium, and large businesses, and it's quite common for customers to pay later than the agreed upon terms. Many businesses don't charge late fees until the invoice is more than 30 or even 60 days past due. Some customers don't pay until you remind them, or they claim to have not received the invoice. So another important factor is whether the business has the resources to pursue collections of past due invoices. When a credit sale occurs, the sale is recorded by the accounting team on the day of the sale with a debit to accounts receivable and a credit to sales revenue. It's easy to think that credit sales are like credit card transactions. They're different. In the case of the credit card transaction, the customer pays immediately with a credit card, and the business must wait a few days to receive the payment, less the merchant credit card fee. So a credit card fee sale is treated typically as a cash sale, with some exceptions I'll talk about later in this video. The advantages of credit sales are increased sales volume. The customers may buy more if they don't have to pay immediately. It may also increase customer loyalty, and offering credit can strengthen relationships with customers. In addition, if competitors offer credit, doing the same helps the business remain competitive. On the other hand, if the competition doesn't offer credit sales, then the business may have a competitive advantage by offering payment terms. There are disadvantages as well. First, there is the delayed cash inflow. Money isn't received immediately, which can strain working capital. Does the business have enough cash to finance the sale? In addition, some customers may never pay, requiring the accountant to set up an allowance for doubtful accounts or record write-offs. And there is the administrative burden of monitoring receivables and collecting payments. The companies I worked for had various approaches. Some had a very strict credit policy, like when I worked for a company that created t-shirt designs that customers used to press onto garments. The cost for a customer to enter the industry was not very high, and that meant that many people also quit quickly. So the business I worked for required prepayment for most orders until we had at least 6 to 12 months experience with the customer. And then the customers had to fill out an application, and we checked their references and their financials. On the other hand, I worked for a software company where most customers were immediately approved for credit. There was no credit policy, but somewhat surprisingly, there were hardly any non-payments. Perhaps that approach would have changed if there were many non-payments. And speaking of credit policy, balance is the key. A credit policy that is tight might lower the risk, but could potentially also lower sales. When the credit policy is loose, there are more sales, but also higher risk. I have found that there is no one-size-fits-all approach to managing credit for a business. The business might have a unique advantage in the marketplace that encourages customers to pay promptly because they don't want to risk not being able to buy from the company again. On the other hand, if there are a lot of players in the industry, customers may order without any intent of paying because they can simply switch to another vendor. So the takeaway is know your business, understand the industry and your customers, evaluate creditworthiness, set limits, and enforce collections. I already mentioned that credit card sales are really cash sales from the business perspective, but there's one exception. Let's talk about that first. If the company has its own credit card and is managing the credit card on their own, not through a third-party bank, then that is also considered a credit sale. This type of situation is rare these days, and most store-branded cards are managed by a third party. Now let's talk about the credit cards like Visa, MasterCard, and bank-issued cards. The advantage is the near immediate cash, minus the fee. There is a lower default risk because the credit card processing company assumes the risk, and customers appreciate being able to pay with a credit card. The disadvantage for credit card sales is the fee, which can range from 1% to 4% and can be higher for online sales, as well as chargebacks when customers dispute charges. The accounting transaction for cash credit card sales is debit cash, debit credit card expense, credit sales revenue. In my experience, though, many companies don't use the cash account for the debit, but rather a temporary holding account to allow the accountant to cleanly reconcile just the credit card transactions. So debit an account like credit card collection, credit sales revenue. Then when the money from the credit card processor is deposited into the bank account automatically, it would be recorded as debit cash, debit credit card fee, credit to the credit card sales collection account. Credit card activity can be very messy in my experience, especially when the company accepts Visa, MasterCard, American Express, and Discover Card for both online shop and sales team activity. The amounts from the same day sales are deposited on different days into the company's bank account, and the accountant may have to closely analyze what credit card payments from what day have been received and which haven't. This is an important account to keep a close eye on. Let's practice on a few examples from our textbook. In this transaction, the business sold merchandise on account to Osaki Company, issued sales slip $1,200 for $2,015, terms net 30. When we analyze this transaction, we find that accounts receivable increased, accounts receivable is an asset, and assets increase with debits. So we need to debit accounts receivable. Sales also increased. Sales is a revenue account, and revenue accounts increase with credits. That means we need to credit sales. We record this transaction by debiting accounts receivable or Osaki Company and crediting sales for $2,015. Next, let's look at what happens when we receive the payment. On June 30th, Osaki Company pays the full amount of $2,015. That means that cash increased, which is an asset, and assets increase with debits, so we debit cash. The amount owed by Osaki, it decreases. That is considered an accounts receivable, which is an asset, and assets decrease with credits. So credit accounts receivable. We record this transaction by debiting cash and crediting accounts receivable or Osaki Company for $2,015. Here's an example for a credit card transaction. On February 2nd, the company sold merchandise totaling $2,300 plus 8% sales tax to customers using bank credit cards. Record the 5% discount on credit card sales at the time of sale. When we analyze this transaction, we see that credit card fees increased. Credit card fees are an expense, and expenses increase with debits, so we debit credit card fees. Cash also increased. Cash is an asset, and assets increase with debit, so we debit cash. Sales increased. Sales are revenue accounts, and revenue accounts increase with credits, so we credit sales. Sales tax payable also increased. Sales tax payable is a liability which increases with credits, so we credit sales tax payable. We're ready to record this transaction, and we write credit card expense in the description column and $124.20 into the debit column, which is calculated by multiplying the sale amount, including sales tax payable of $2,484 by 5%. The next line, we debit cash for $2,359.80, which is $2,484 less the credit card fee. Then on the third line, we slightly indent, write sales and a credit for $2,300. And on the last line, we credit sales tax payable for $184, which is calculated by multiplying $2,300 by the 8% sales tax. I hope this video helped you understand credit sales, the advantages and disadvantages, why credit policies are important, and how credit sales are different from credit card sales.